This past week, the stock market had a very positive week. All 5 days were positive, and it finished, of course, positive at the end of Friday. I'm going to comment on what's going on in the market. Is that going to last? Or is it the beginning of a new bull market? Even if it's a shorter-term bull market, I'll comment on all of that. Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is November 7, 2023. I'm going to play several clips for you, and a lot of times you know this if you watch, that a lot of times I kind of take the counterpoint to the position that the market always goes up, because a lot of traditional financial advisors always take the position, they always want the market to go up. Well, it doesn't. And sometimes it goes down, sometimes it goes down a lot. So with the market as elevated as it is, I'm oftentimes taking the other position to say, be careful. There's risk out there. And over the last couple of years, we've seen some of that risk. I think there's a lot more ahead of us. But on the other hand, I'm not a negative person, and I'm not looking for negative news. I'm just trying to point out kind of a counterbalance to the typical narrative out there. With this week being a very positive week in the market, I want to emphasize that. So you can see that I'm not always a negative Nelly. The market took off after Chairman Powell's comments that he was cautionary on the interest rate hikes and so forth, but he did leave the door open for future rate hikes. But the market took that as positive, and it ran with it. So I'm going to play some pieces for you from different perspectives, both positive and one that's balanced and one that's more on the negative side, I guess you'd say. And so different perspectives, and I like to do that so you can see the people that I'm listening to get news from, whether it's positive or negative. I'm trying to get people who are not just hacks, who are take one position no matter what goes on in the market. So with that, Scott Wapner interviews Jeffrey Gundlach, the CEO of DoubleLine, and he is echoing a cautious tone in the market, saying, be careful. This may not be the beginning of a new bull market. The bear market is not over, so to speak. So anyway, it's an interesting piece. I think Jeffrey Gundlach has a lot of credibility, and Joe Kernan is kind of digging for information from him, but I think you'll find it helpful. Take a listen.
We'll ask the legendary bond investor Jeffrey Gundlach about all of that. He does join us right now exclusively to react, the CEO, CIO, co-founder of DoubleLine Capital. Jeffrey, it's a pleasure to have you here on Fed Day as always.
Yes, Judge, good to be back for Fed Day. Not a lot of, Josh is right, not a lot of news today. Is almost a direct repeat of the last meeting. Carefully, he said that very early on and repeated it. I think the market likes carefully. So stocks rallying, bonds obviously rallying too. We're down now about 25 basis points. But also, he said they're not even talking about cutting interest rates. They're not even having a discussion about it. And yet at the same time, he's not confident that they're sufficiently restrictive. So the door was left pretty much wide open for future flexibility at meetings. And, the yield curve is completely flat. So it's kind of in the same mode, I think, that the Fed's tone was, that Jay Powell's tone was, and that's a reason why you can rally after this brutal sell-off in long rates over the past 2-3 months.
So next is another video, which is a clip showing two views on the labor market. And again, see, the first video covered Jeffrey Gundlach. This one also covers a piece from him. It's a different interview. It's by Kelly Evans. So, but it's talking on the labor market. He's taking the position that layoffs are coming, and he states why. Then they interview Evan Sohn from recruiter.com, and he makes the case for the fact that the labor market is strong, and he tells why. So two counter views on the economy, and but I wanted to play this just so you had back-to-back two views, and this is not the stock market, this is the economy. So take a listen.
Let's move on now to the labor market, which has been the pillar of strength in this economy. But DoubleLine's Jeffrey Gundlach doesn't think that will persist.
I really believe that layoffs are coming. I think we've seen hours come down, we've seen hiring freezes, and now we're starting to see layoff announcements, not en masse, and not on but they're out there in financial firms and technology firms, and I believe that's going to spread.
Although my next guest says his data kind of shows the opposite. His firm, Recruiter.com, saw a jump in open positions for job recruiters last month, typically an early indication for a pickup in hiring. For more, let's bring in Evan Sohn. He's the chairman of Recruiter.com. Evan, it's good to see you. And is this a new development?
Good to see you as well. Look, I think Jeffrey's right. There are layoffs coming. We're seeing them in the hundreds and in different sectors. I think when you talked about recruiters, and finally now we're seeing recruiter open roles for recruiters jumped 8% month over month from our partners over at Aura and the Aura report. That's a leading indicator. So I think the tech companies that laid people off earlier in the year, that was successful. They reset their overall companies themselves, and now they're looking to hire again. Salesforce.com, notably, they made major layoffs earlier in the year, and then they recently announced they're going to be hiring lots of people, and they're gearing up for that by hiring recruiters. Recruiters are a leading indicator of both job openings and then recruiters as well.
Next, I want to play a video from the CEO of Brian Cornell, the CEO of Target, and he's going to talk about the retail market. Now, Target is probably a pretty good bellwether because the shoppers cover a pretty broad spectrum. And what he's saying, it's interesting, what he's saying is that spending is down. The shoppers are there, they're buying things, but they're buying them in smaller quantity and maybe even smaller items. So the dollars being spent are less. What that tells me, because of the spectrum, I guess, of Target customers, what it tells me is that there is a squeeze on the consumer and their ability to pay for the things that discretionary items, or maybe even necessary items, things that they've been buying in the past. And you can tell from his tone, he's a little bit concerned because, and this is, I think, foreshadowing a slowdown in the economy. Now, is that going to crash or be a recession? I don't know that. He's not saying that. He's just saying that spending, retail spending, is down, and he explains some detail behind it. So take a listen to Brian Cornell.
Target CEO Brian Cornell sat down for his first television interview since March to talk about some of the challenges facing the retailer. Everything from the backlash around Pride Month merchandise and messaging to the crunch that consumers are still feeling from high inflation. We started with what Cornell learns from shoppers' behavior.
They're managing that budget really carefully. And it's certainly pressuring discretionary spending.
Meaning they're buying less stuff.
They're buying less stuff. Even within food and beverage. Again, we look at overall retail spending, just look at the top line, you say, all right, a really healthy consumer, and they are spending. But even in food and beverage categories, over the last few quarters, the units, the number of items they're buying, has been declining. So they're even tightening up their spending in those categories. But in discretionary goods, we've seen 7 consecutive quarters of both dollars and units declining. So you're buying less apparel, less items for your home, fewer toys. You're seeing some of the pressure in those categories. Now, those cycles are going to change, and you've been reporting about categories like toys, seeing pretty significant declines. But the other trend we are seeing, and we've seen really for several years now, is the American consumer is enjoying those seasonal moments, whether it's Halloween or the summer moments, going back to Mother's Day and Father's Day. They're still enjoying those moments, and they keep looking for newness.
But what you're describing of sales of goods being down 7 quarters in a row. I mean, that's a goods recession. We see places in our economy where things look great. The GDP came back up 4.9% for the third quarter. But what you're describing sounds like a recession in certain areas of the economy.
Becky, I think it's really fair. I think it's why it's so important not just to look at the top line, but to double click and say what's happening in different categories. What's the pressure of the last 3 or 4 years of rising costs doing to how Americans are budgeting each and every week? And what are they trading off? Right now, again, for 7 quarters, they're buying fewer discretionary items. And they're not buying the goods that they were during the pandemic.
So still on the cautious side, I'm going to play some positive things following this one, but this is SoFi's Liz Young being interviewed by Scott Wapner, and she is also kind of ringing a cautionary tone as well, saying that there's probably more downside market risk ahead of us. So take a listen to this.
Whether seasonality can spur stocks higher into year's end. Let's ask Liz Young, SoFi's head of investment strategy, with me here at Post 9. It's good to see you. Welcome back.
Good to be here.
So what do you think? As we, seasonality definitely gets better. November, best month historically. December, second best. It's like good riddance to the last 3. But, you've been kind of cautious. So what do you see now?
Yeah, well, I mean, the 3 months in a row that we've had since the most recent top in July have been orderly but tough and persistently tough. And it seems to me like there are people looking for more reasons to sell than reasons to buy. And we continue to have this downward momentum. And we're not really getting a lot of reasons to stop doing that. Granted, we didn't have a catastrophe. There hasn't been some sort of negative shock. There have continued to be headwinds. And I think we're aware of what all those headwinds are, which is the good thing. We know what the big risks are out there. But there continues to be this momentum and sentiment that we're just not sure. We're getting to the end probably of the hiking cycle. When will those legs kick in and how bad will they be?
Okay.
So going to the other side now, looking at the positive side, so I want to play you the reasons why people feel that this is the beginning of a more positive market ahead of us. Joe Kernan is interviewing Sylvia Jablonski, who's the CEO of Defiance ETFs. And she is saying, now's the time to get invested. Load up. The market's going up from here, basically. Now, she's not an older person. It looks like she's a younger person, so maybe she views this through the eyes of a younger person. And if that's the case, absolutely, this would be true. Get invested. But anyway, this is an interesting interview showing the positive side of what's potentially going to be happening in the market. So take a listen.
Joining us now, Sylvia Jablonski, CEO and Chief Investment Officer of Defiance ETFs. Sylvia, do you ever not think long term? Because that's your point today. Let's take a step back and try to figure out why we're doing this in the first place. And it's to build wealth. And if you are going to build wealth, it'd probably be better to go into, for example, the NASDAQ now, better than it was 3 months ago.
Absolutely. Good morning, Joe. Well, I think, it feels like the obvious strategy, right? You sort of want to spend your life, especially if you're younger, dollar cost averaging into your positions and you accumulate wealth over time. But what we actually see and what we've seen in the last couple of months is investors running for the hills. So they've either been parked on the sidelines and not invested at all, or else they've been in the market. They've seen that 10% correction. 2/3 of the S&P 500 names are actually below their 200-day moving average. And you see the sell-off in those names. So I think that, investors often get this sort of panic tick, right? You have uncertainty in the Middle East. You have uncertainty with the Fed, debt issuance this week. There's sort of all sorts of unfamiliar things that are going to happen in the next couple of months. And that has sent investors out of the market. But really, they should be buying now. To your point, would you rather buy NASDAQ 10% off of its July high, now, or wait until it rallies 10% into the end of the year?
Now, Joe Kernan is interviewing Steve Eisman from Neuberger Berman, and he is saying, this is interesting, he's saying the consumer is okay. They are spending, but they are not spending on big ticket items, or it has slowed down a lot. For example, homes. With interest rates where they are and prices where they are, the consumer has, I won't say they've stopped, but they've certainly slowed way down. And then he goes on to say auto purchases, and of course I know auto sales are down now, and anything where the consumer, at least some of the consumers, need to borrow money. And he even goes on to say solar panels. So big ticket items. But he says, but people are still willing to buy a $7 or $8 cup of coffee at Starbucks. So, but the consumer, depending on how you look at it, is probably doing okay, particularly in the smaller items. So take a listen to Joe Kernan and Steve Eisman.
Joining us now, Steve Eisman. He's senior portfolio manager at Neuberger Berman, and I always hesitate to put words in your mouth, so I'm not going to do that. But let me just say this: last time, a matter of record, you said no on the banks. Do not invest in the banks. And what I interpreted that to mean was that credit conditions were tightening, even though the Fed hadn't made any moves recently. And we saw the 10-year move up above 5%. In the absence of any Fed hikes, which is sort of the market doing some of the work for the Fed. Is that true?
Kind of.
Okay.
I mean, I've said many times the banks right now are uninvestable, and it's three reasons. Number one, they're losing deposits.
Okay.
So net interest margins are going down. Loan growth is tepid at best because they're losing deposits. And the regulators have raised capital requirements again, and that's not even hit returns, and they won't hit returns till sometime next year or the year afterwards. And we haven't even had a credit cycle yet.
Does this all indicate to you that it's only a matter of time till something else breaks, like 6 months ago or whenever that was? Is that on the horizon? Or
I mean, look, if I knew what would break, I'd tell you.
Does Jay Powell think it's possible?
I'm sure he thinks it's possible. I mean, let me just change gears for a second. I thought the most interesting part of this earnings season was comparing Visa to TransUnion, because Visa showed the consumer is still spending, and it didn't beat volume, it didn't miss volume, it was exactly in line. So the consumer, in terms of his or her spending, is fine. But TransUnion came on and basically said that loan volume on the consumer side has collapsed. That the bank tightening, the higher rates is causing loan volume really to go down a lot. The fact that TransUnion was down 25% in one day is literally shocking, that a company like that could be down that much. But that hasn't hit the economy yet. I mean, the yin and yang is that the consumer is still healthy, but they can't spend money on big ticket items because they can't borrow. So they're spending it, and maybe that's why Starbucks was so good. They're spending it on a more expensive cup of coffee.
What I'm hearing, and it's sort of a nuance that I wasn't considering, if loan growth slows, it's not necessarily because demand is slowing with people who want loans. It could be that deposits have fled, so the banks are...
Well, the banks are tightening, and also you're not buying a house at an 8% mortgage because you can't afford it.
So in that case, it is because...
Yes, the part of the economy that I think is the most worrisome right now is anything that's a large ticket that the consumer needs to borrow to buy. So house, auto, solar panel, et cetera. Everything else seems to be doing okay on the consumer side.
Finally, Stephanie Link is making the case for now is the time to buy. Now is the time to buy equities. And again, a very positive outlook. People like Stephanie Link, however, I want to point this out, she will typically be positive no matter what's happening with the market. That's the traditional financial advisor view. If the market's going down, they say you stay invested, you can't sell now, et cetera. No matter how far down it goes, they are pitching a positive tone, never providing advice on or insight into when risk enters the market, maybe you should lighten up or maybe you should get out. They don't have that view. So while she does have a view that is positive, I would say from what I have heard from her or people like her, they tend to have this consistent view of the market's always going up. And if it's not, it will pretty soon. So, and I don't agree with that. But this is the positive view, so you can take a listen to Stephanie Link.
Let's bring in our market panel. Joining us now, Scott Wren from Wells Fargo Investment Institute and Stephanie Link from Hightower Advisors. Stephanie, do you buy it? Like literally, this rally post-Fed, right ahead of the jobs report and all these earnings this afternoon, should investors believe that this is solid.
Yeah, I do. I actually think we are set up for a rally into the end of the year. We've already had a couple of days, nice days. And I think the laggards are going to likely lead us, which we saw today, right? All the tax loss selling companies and stocks that got kind of washed in that whole theme. They really exploded today, for sure. But the reason I'm positive really is because the data today was really the sweet spot for the Fed and for what we want. We want inflation to come down. We had unit labor costs come down. We had productivity, the best in 3 years. And we also know PCE has also been coming down. So inflation is doing its job in terms of coming down, still have progress to go, but it's good. And then growth. We're not growing 4.9% like we just grew in the third quarter. We're going to slow, but I think we're going to be able to do 2%. And that is good for earnings. And by the way, earnings have been better than expected. Seasonally, this is a good setup time, right? And I think that there are a lot of people that are off foot right now, right? A lot of negativity out there. Sentiment is really pretty crummy. So I'm a buyer, and I've been buying the last couple of weeks.
Now, I want to show you three charts, and I'll make this brief, and I'm about to wrap up here. But I want to make the case for the fact that I think, at least in the short run, it looks like the market is going up. And I don't know how long this is going to last, but right now the indicators would be positive. These are economic data, not necessarily market data. But they support a positive view on the market, particularly in light of the fact that we've had a correction, and Chairman Powell's comments were could be interpreted as positive, or at least not negative. This is the so three charts. Number one, the U.S. non-farm labor productivity. So this goes back to 2005, and you can see it goes generally in one direction. And the current, I put an arrow there, the current direction is up. Productivity is up. Now, when you can contrast that with the U.S. unit labor cost quarter over quarter is down. So productivity is up, labor cost is down, and U.S. factory orders month over month is up quite a bit. So with factory orders up, productivity up, labor costs down, to me that spells, at least for the foreseeable future, maybe the short term to intermediate term, a positive view on the market. So again, the economy and the market are two different things, but economic indicators like this look positive. Okay, we can't take her anywhere. Inflation is a problem. It's still a problem. Yes, it's come down some, but it's not down from where it started. Just the rate of change is down, but it is still up, if that makes any sense. So people who are, you and I, who go to the grocery store and buy things, and we see what prices are, they're expensive. So I understand this cartoon. Thank you for watching. If you have any questions or comments, leave them in the comment section below. Thank you.